Hey everybody, welcome back to Accounting 2210. In this video, we're going to take a look at the tax calculation. And if you've done a tax return before using tax software like maybe TurboTax or the H&R Block product, you might be thinking, okay, well, why do we need to learn how to calculate tax? Because, the software is going to do all that for us. And that's true to some degree. But learning how that tax calculation comes together is going to set the table for understanding a lot of what the tax law is all about. So in this lecture, we're going to try to put that piece of the puzzle in place here and understand how that calculation comes together, how we go from our income to an amount that we have to pay on the tax return. So buckle up and here we go. I mentioned last time in the video that in 2018 we had the Tax Cuts and Jobs Act, which really kind of overhauled the way we do taxes and a lot of the different laws that are in the tax code. Probably the biggest single overhaul of the tax code since 1986. So we're talking, 30 plus years since we've seen a overhaul of that nature, that magnitude. The tax code changes every year, sure, but what we saw in 2018 with the new Tax Cuts and Jobs Act was a really big overhaul. One of the things that it promised to do was simplify the process of doing your taxes. And to that end, they said, we're going to make a form that fits on the size of a postcard. That's a 1040 now. It's going to fit on the size of a postcard. It's going to be so simple. So that's what we're looking at here. And as I mentioned in the other video, they kind of gotten away from that going forward in 2019 and gone back to the two-page form for the 1040 plus all the other supporting schedules. But this is what it looked like in 2018. And you can kind of see a tax calculation built in. We got wages and income up here at the top. There's our total income. Then we have adjustments that we're making for gross income. So we're going to subtract those out. Then we have our standard deduction or our itemized deductions. We're going to subtract that out. We're going to subtract out something called qualified business income, which was new in 2018 as part of the Tax Cuts and Jobs Act. Then we're going to take all that stuff together, and then we're going to come up with a taxable income amount. What am I actually going to pay taxes on? What amount of income? And then you can see we've got our tax that we're going to fill in there. Then we're going to have some credits that we can back out that are going to help lower the amount of tax that we are liable for. And then finally, you can kind of see we've got the total tax, how much was taken out from W-2s and any other kind of payments that we might have made. And we get a total amount that we have paid in. All that together, we either get a refund or we have to pay more. Okay, so that tax formula is built into the form. But we're going to break it down bit by bit and kind of show you how it comes together because, like I said, that leads to an understanding of all the various components of the return. So it's important that you have a handle on it. There it is, the tax formula. And you're probably going to look at that and think, oh my gosh, I have to have that memorized. And I'll say, yeah, I'm not going to ask you on an exam to write that out by hand. But the more familiar you are with the tax formula, the more everything else is going to make sense from here on out. So it's definitely worth your time to maybe jot this down on an index card, keep it handy, refer back to it, and just kind of keep it in the front of your mind. We start off with gross income. We subtract out our deductions for adjusted gross income, like I showed you right here at the top. That gives us AGI, or adjusted gross income. We subtract out either a standard deduction or the itemized deduction on Schedule A. We subtract out any qualified business income that we have. And then we get taxable income. We multiply that by the tax rate. We get gross tax. We subtract out any credits we have and payments that we've made. And then we get the amount of tax that we have to pay in further or the amount of the refund that we get. So one by one here, gross income. We talked about in video number 1 that the IRS came up with this great idea in Amendment 16 to say that income is income from whatever source derived, unless we specifically say we exempt it. So gross income is quite literally all the income that you make. It's a very wide definition. The deductions for adjusted gross income include things like student loan interest, contributions to qualified retirement plans if you're eligible to take that deduction. And what that does is it kind of lowers the taxable income that you have. That gives us AGI. Adjusted gross income is often called the magic line because a lot of the phase outs that we'll talk about when we get to medical expenses and charitable contributions are based off of that AGI number. So it's a very important number, and that's why we kind of have that subtotal right there. Next up, the standard deduction is a deduction that we get pretty much just for being alive. Most all taxpayers are eligible to take a standard deduction. If you are a single taxpayer, that number is $12,000. If you are a married filing joint taxpayer, that number is $24,000. And we'll kind of go into this a little bit deeper later on, but just be aware that before 2018, all of these standard deductions were about half of the amount they are now. One of the things the Tax Cuts and Jobs Act did was it, in effect, doubled the amount of standard deduction that people could take. And in doing so, it really is reducing the number of people that are going to itemize. Because I can, as a taxpayer, can pick, do I want to take the standard deduction or do I want to itemize and deduct things like medical expenses and charitable contributions and home mortgage interest and all that good stuff. So now we're kind of in a situation where most average taxpayers can't itemize anymore, or I should say it's not in their best interest to itemize anymore, simply because that standard deduction of $24,000 is so high. It's hard to get enough itemized deductions to clear that hurdle. So we'll talk about that more in later chapters. QBI, just a quick note, those amounts that you're looking at there for 2018, and those are indexed. The IRS changes those every year and usually bumps them upward. So in 2019, for returns filed in 2020, those amounts all go up about $200 to $400 right there. Next line, QBI, qualified business income. That used to be exemptions. You used to get a ballpark $4,000 exemption for yourself, your spouse, and every dependent that you claimed. The Tax Cuts and Jobs Act eliminated all of that. So you don't get a personal exemption anymore. Again, we kind of baked all that into that standard deduction. They raised the child tax credit. They did some things that hopefully offset that for most taxpayers. So personal exemptions are gone. I don't get to claim an exemption for myself anymore. I don't get to claim one for my spouse. I don't get to claim one for my dependents. That provision in the new tax law is set to go away in 2025. So if that's not renewed, personal exemptions will come back in 2025. It's kind of like waiting for the 20-year cicadas that come out in Ohio or whatever they are. You know, we're just all sitting around waiting for the exemptions to come back. We struck out QBI, and we get taxable income. We multiply that by the tax rate, gives us gross tax. For our purposes, a lot of the times we're either going to let the tax software calculate it, or if we're doing things by hand, we'll look up the tax in tax tables, which I'll show you how to use in a second, and then also tax rate schedules, which we'll demonstrate later on. Once we have that gross tax amount that we're liable for, we look at the credits and payments that we've made. We subtract those out, and again, I've said before, that gives you the amount that we have to pay in further or that we get back. All right, how about an example? Bill is a taxpayer. He's single, 27. In 2018, he earned a salary of $29,000, had a little bit of interest income on the side of $1,500. In addition, he has deductions for AGI of $2,200, and he has $6,500 of itemized deductions. So using that tax formula, we're going to calculate gross income, AGI, standard, and the taxable income. I'm sorry, standard or the itemized, depending on which one's bigger, and taxable income. So I'll pause here for a second, let you kind of figure that out, maybe jot down some answers or get an answer in your head, and then we'll check them. All right, hopefully you had an opportunity to pause and work out the problem, and we're going to look at the solution right now. There we go. Gross income, $30,500. We would get that by taking his salary, adding in interest income, keeping in mind that provision. The IRS is going to get their hands on all your income, regardless of how you got it. We'll talk about exceptions later on, but that's kind of the general rule of thumb. Deductions for AGI. We're going to take out $2,200 because it says in the problem he had deductions of $2,200. We get an AGI of $28,000. $300. Again, that number is important because a lot of the phase outs we'll talk about later on are going to be based on that number right there. Now we get to pick the bigger of the two, standard or itemized deduction. Even though he had $6,500 in itemized deductions, we're not going to claim those. We're going to take the standard because it's worth more. Now there is a case where if we have married filing separate taxpayers and one of them itemizes, we would have to make the other one itemized too, because the tax law says if you're married filing separately, both of parties have to file and calculate their return in the same way. So if one party itemizes, the other one has to also, regardless of if it's better or not. We'll get into that in our next video. QBI we'll talk about later on. Nothing in the problem about QBI. So we get taxable income of $16,300. Now, what do you do after that? How do we figure out the tax liability? We know how much our taxable income is. Where do we get the amount that is owed in taxes? There are tables that we can use if the income is under $100,000 for taxable income. If it's over $100,000, we look at a tax schedule and do a calculation. We'll look at those later on, but I want to show you right now how to use the table. Both of these are in Appendix A of your book. There's my tax table, 2018 tax table, and real simple. I look at the filing status and I look at the taxable income amount, and I just kind of connect the two. He had $16,300 in taxable income. So I'm going to find single, I'm going to find 16,000, and I'm just going to work over. Now, where it can get a little confusing, you'll notice you have two numbers on there for 16,300. You need to pay attention. Less than 16,300 is not 16,300. We want to be in the at least, because 16.3 is at least 16.3. So we're going to use that second number. We're going to come down from single, and there it is right there. 1,769 is my tax liability. Now at that point, I would look and see what I had paid in, either through W-2 withholdings or other payments to the IRS. If I had paid more than that, I get a refund. If I had paid less than that, then I'd have to owe more. I'd have to send money into the IRS with my return. So we'll look at some more examples of that in our homework. Next time, we'll talk about the filing statuses and tell you what you need to have to be able to file single, married filing joint, married filing separate, qualifying widower, or head of household. So hope to see you back online for that video. If you have any questions in the meantime, feel free to contact me. Email is always open. You can text me. My number's in the syllabus, or you can come to class and bring your questions with you there. We'll see you next time.